I've spent the last 50 years studying market cycles, managing the world's largest hedge fund through multiple crises, and documenting every major market crash going back 400 years. And I need to tell you something that most investors don't want to hear. The patterns that preceded the 1929 crash, the 1987 Black Monday, the 2008 financial crisis, they're all showing up again right now. And if you don't know what to look for, you're going to be caught completely off guard when it happens. Let me be very clear about something from the start. I'm not a fortune teller. I can't tell you the exact day the market will crash. But what I can tell you, based on decades of research and managing Bridgewater Associates through multiple market cycles, is that markets move in predictable patterns. And these patterns are as reliable as the seasons. The problem is most investors have what I call historical amnesia. They forget that what's happening today has happened before, just wearing a different costume. You see, most people think market crashes come out of nowhere. They wake up one morning, check their portfolio, and suddenly their retirement savings are cut in half. But that's not how it works. Market crashes are never sudden. They're the result of forces that build up over years, sometimes even decades. And if you know what these forces look like, you can see them coming from miles away. So in this comprehensive analysis, I'm going to walk you through exactly what always happens before a market crash. I'm going to share with you the framework I've developed over my entire career studying what I call the big debt cycle, the same framework that helped Bridgewater navigate the 2008 crisis when most other funds were getting destroyed. And more importantly, I'm going to show you what these patterns look like in today's market so you can make informed decisions about protecting your wealth. Now, before we dive into the patterns themselves, I need to explain something fundamental about how I see the world. Everything in economics and markets moves in cycles. I call this the big debt cycle, and understanding this cycle is the key to understanding when crashes happen. Throughout history, economies go through the same sequence over and over again. First, there's the expansion phase where debt grows, asset prices rise, and everyone feels wealthy. Credit is easily available, borrowers are confident they can repay, and lenders are confident they'll be repaid. This creates a self-reinforcing cycle. More lending leads to more spending, which leads to higher incomes, which supports more lending. Then there's the peak, where debt levels become unsustainable relative to the income needed to service that debt. This is the moment when the music stops, though most people don't realize it at the time. Lenders start to pull back, asset prices stop rising, and the first cracks appear in the system. Then comes the contraction, where debt needs to be paid down or written off, and asset prices collapse. This is what we call a deleveraging. It's painful, it's deflationary, and it can last for years. The debt burdens that felt manageable during the expansion become crushing during the contraction. And finally, there's the bottom, which sets up the next cycle. Debt levels have been reduced, asset prices are low, and the conditions are in place for a new expansion to begin. This isn't just theory. I've documented this pattern going back hundreds of years across dozens of countries. And every single time the crash happens for the same fundamental reasons. The details change. The names of the companies and the specific assets involved are different, but the underlying forces are identical. So let me take you through the four patterns that always, and I mean always, show up before a major market crash. These aren't just patterns I noticed. These are the fundamental forces that drive every crash, from the tulip mania in 1637 all the way to 2008 and beyond. The first pattern is what I call bubble psychology, or what economists sometimes refer to as irrational exuberance. This is when investors stop caring about fundamental value and start buying assets simply because they believe prices will keep going up. They're not investing based on cash flows or intrinsic value. They're speculating based on momentum and the greater fool theory. Let me give you a perfect example from history that illustrates this pattern in its purest form. In the 1630s, the Dutch experienced what became known as tulip mania. Now, you might think that sounds ridiculous. How could intelligent people pay fortunes for flower bulbs? But that's exactly the point. Every bubble looks ridiculous in hindsight, but at the time, participants always have seemingly rational explanations for why prices should be high. In the case of tulips, they started as genuinely rare and valuable luxury goods. Wealthy merchants used them as status symbols. This was during the Dutch Golden Age, a period of tremendous prosperity and economic growth. The Netherlands had recently gained independence, launched the East India Trading Company, and was dominating global trade. Money was flooding into the country, and people were looking for ways to display their wealth. At first, tulips were just expensive flowers. One historian estimates that a pound of tulips sold for roughly an average month's salary. That would be like paying $3,300 for flowers in today's terms. Steep, certainly, but understandable for a luxury good marketed to the wealthy. But then something interesting happened. The Dutch invented futures contracts for tulips. People could now buy contracts that locked in a price today for flowers they would receive next season. This financial innovation allowed speculation to enter the market. You didn't need to actually want the tulips anymore. You just needed to believe that someone else would pay more for them later. As tulip prices kept rising, the futures contracts themselves became valuable. If your contract says you can buy tulips for $3,000, but tulips are now trading for $30,000, the contract itself is worth $27,000. People started trading these contracts, flipping paper rather than actual flowers. This is when bubble psychology really took hold. People stopped asking what a tulip was actually worth and started asking what price they could sell it for tomorrow. Confidence became self-reinforcing. Prices rose, which attracted more buyers, which pushed prices higher, which attracted even more buyers. At the peak, some tulip bulbs sold for the equivalent of 5 years of average salary. That's like paying $200,000 for a flower bulb today. That's the price of a home, not a plant. But at the time, people convinced themselves it made sense. Tulips were rare, demand was growing, and even if prices fell, you could always grow more tulips when the market recovered. This rationalization is crucial to understanding bubble psychology. People don't think they're being irrational. They genuinely believe they have good reasons for paying extreme prices. This time is different, they tell themselves. The fundamentals have changed. The old valuation methods don't apply. The bubble eventually burst, as all bubbles do. And when it did, tulip prices collapsed by over 95%. But the collapse didn't just affect tulip prices. It brought down the entire futures market and destroyed the value of land used to grow tulips. Everything connected to the bubble was contaminated. Now, let me fast forward to show you how this exact same pattern played out in more recent history. In the late 1990s, we had the dot-com bubble. Internet stocks were soaring despite having no profits, no clear business models, and in many cases, no revenue at all. I remember watching companies go public with billion-dollar valuations based on nothing more than a website and a business plan. When I asked investors how they valued these companies, the answer was always the same. It's a new paradigm. The internet changes everything. The old metrics don't apply. You have to value these companies based on eyeballs or page views or network effects, not on boring things like earnings and cash flow. This is the phrase you should always watch for. This time is different. Anytime someone tells you that the old rules don't apply because of some new technology or new paradigm, you should immediately be on high alert. I've heard this phrase before. Every single bubble I've witnessed in my 50-year career. Before the 1987 crash, people said portfolio insurance made crashes impossible. Before 2000, people said the internet changed everything about valuation. Before 2008, people said housing prices could never fall nationwide because they'd never fallen nationwide before. But it's never different. Human psychology doesn't change. Greed, fear, the herd mentality, these are constants throughout history. The specific assets change, the technology changes, but the underlying psychology remains the same.
So how do you spot bubble psychology in real time? There are several telltale signs I watch for. First, you see valuations that can't be justified by any reasonable estimate of future cash flows.
In the stock market, that might mean price to earnings ratios that are 2 or 3 times higher than historical averages, with no corresponding increase in growth rates or returns on capital. In real estate, it might mean home prices rising faster than incomes for years on end. In cryptocurrency, it might mean assets with no intrinsic value whatsoever trading for thousands or millions of dollars. Second, you hear constant references to new paradigms and new eras. The old metrics don't work anymore, people say. We're in a fundamentally different environment. The rules have changed. Whenever I hear this, I know we're in the late stages of a bubble. Third, you see massive amounts of leverage entering the system. When people are so confident that prices will keep rising, that they're willing to borrow money to buy assets, that's when you know the bubble is getting dangerous. Leverage magnifies returns on the way up, but it also magnifies losses on the way down. And when everyone is leveraged, a small decline in prices can trigger a cascade of forced selling that turns into a crash. Fourth, you see retail investors and non-professionals flooding into the market. When taxi drivers are giving stock tips, when hairdressers are day trading, when people who have never invested before are suddenly putting their life savings into the market, that's often a sign we're near a peak. Not because these people are stupid, but because they're the last wave of buyers entering the market. After all, the professional investors have already positioned themselves. Fifth, you see the financial industry creating increasingly complex products to feed the demand. Synthetic CDOs before 2008, triple leveraged ETFs, exotic derivatives. These products exist to extract fees from investors who are chasing returns in an overheated market. The second pattern that always appears before a crash is what I call debt saturation. This is closely related to the big debt cycle I mentioned earlier, and it's perhaps the most important pattern to understand because it's the fundamental force that drives the largest crashes. Here's how it works. In the early stages of an economic expansion, debt is productive. Companies borrow money to build factories, invest in research and development, hire workers. Families borrow money to buy homes and start businesses. This debt fuels economic growth, and as the economy grows, it becomes easier to service that debt. Your income is rising, so your debt payments become more manageable over time. But over time, something subtle but dangerous happens. The debt starts growing faster than the income needed to service it. At first, this isn't a problem because asset prices are rising. If you're struggling to make your mortgage payment, you can refinance or take out a home equity loan because your house is worth more. If a company's cash flow is tight, they can issue more debt because their stock price is rising and investors are optimistic. But eventually, you reach a point where debt levels are so high that all the new borrowing is just going to service the old debt. You're not borrowing to invest in productive assets anymore. You're borrowing to pay interest on previous loans. This is what I call debt saturation, and it's incredibly dangerous because it means the system has become a Ponzi scheme. It only works as long as new borrowing continues to increase. Let me walk you through how this played out in 2008, because it's the perfect example, and it's recent enough that many of you lived through it. In the early 2000s, interest rates were very low, The Federal Reserve had cut rates to 1% to stimulate the economy after the dot-com crash and 9/11. These low rates made borrowing very cheap, and people did exactly what economic theory predicts they would do. They borrowed. People borrowed to buy houses, they borrowed to buy cars, they borrowed to finance consumption and maintain lifestyles that their incomes couldn't actually support. But here's the key. They weren't borrowing based on their ability to repay the loans from their income. They were borrowing based on the assumption that asset prices, particularly house prices, would keep rising. As long as your house was going up in value by 10 or 15% per year, you could always refinance or sell if you got into trouble. The banks loved this arrangement because they were making enormous amounts of money originating these loans, and they didn't even keep the risk on their books. They bundled these mortgages together, sliced them up into complex securities called mortgage-backed securities and collateralized debt obligations, and sold them to investors around the world. The investors bought them because rating agencies gave these securities AAA ratings, making them look as safe as government bonds. This created a feedback loop that I recognized at the time as unsustainable. More lending led to higher house prices. Higher house prices encouraged more lending because homes could be used as collateral. Higher prices also brought in speculators who bought multiple properties expecting to flip them for quick profits. And all the while, the underlying debt levels were climbing higher and higher relative to income. By 2006, household debt in the United States had reached 130% of GDP, the highest level in American history. At Bridgewater, we were tracking these numbers very carefully, and we knew they couldn't be sustained. The mathematics were simple. Either incomes had to rise dramatically to support the debt, or debt had to come down through defaults and deleveraging. And since incomes weren't rising fast enough, we knew it would be the latter. The crash started in 2007 when subprime borrowers, people with weak credit and low income, started defaulting on their mortgages. At first, everyone said it was contained, just a small problem in one corner of the mortgage market that wouldn't affect the broader economy. But we knew better. When you have a system that's saturated with debt, it doesn't take much to trigger a cascade. As subprime borrowers defaulted, the value of mortgage-backed securities started falling. Banks that owned these securities had to mark them down, which reduced their capital. As their capital fell, they had to sell other assets to meet regulatory requirements. This pushed down the prices of those assets, which hurt other banks and investors. And the cycle fed on itself. By 2008, major financial institutions were collapsing. Bear Stearns failed in March. Lehman Brothers failed in September. AIG, one of the largest insurance companies in the world, required a government bailout of over $180 billion. The entire global financial system was on the verge of collapse, and only massive government intervention prevented a complete meltdown. This is what happens when debt saturation meets a downturn. The deleveraging process becomes self-reinforcing. Falling asset prices lead to more defaults. More defaults lead to tighter credit conditions. Tighter credit leads to less spending. Less spending leads to lower incomes. Lower incomes make the debt burdens even more crushing. And the cycle continues until massive amounts of debt have been written off, restructured, or paid down. Now, here's what concerns me deeply about today's situation. We're seeing debt levels that are even higher than they were before 2008. Global debt is now over 300% of global GDP. In the United States, government debt has surpassed $35 trillion, roughly 130% of GDP. Corporate debt is at record highs. And much of this debt was accumulated when interest rates were near zero. Think about what that means. Companies, governments, and households took on enormous amounts of debt in an environment where borrowing costs were artificially suppressed. Now interest rates have risen significantly from those lows. What happens when all this debt needs to be refinanced at higher rates? The answer is the same thing that always happens. Entities that can't afford the higher interest payments start defaulting. Governments have to cut spending or raise taxes to service their debt, which slows economic growth. Consumers pull back on spending because more of their income is going to debt service. Companies that were profitable at 2% interest rates become unprofitable at 6% rates, and the economy contracts. This is the inevitable consequence of debt saturation. You can delay it through various means. Central banks can cut rates. Governments can run larger deficits. Accounting rules can be changed to hide losses. But you can't avoid it forever. Eventually, the debt has to be dealt with, either through repayment, default, or inflation. The third pattern I watch for is what I call innovation risk. Now, this might sound counterintuitive. Innovation is good, right? New technologies, new financial products, these things drive progress and create wealth. And that's true. But innovation also creates crashes. And understanding why is crucial to avoiding catastrophic losses. Here's the key insight. When something new comes along, whether it's a new technology, a new type of financial instrument, or a new market structure, there's a period where nobody really understands the risks. The innovation seems brilliant. It appears to solve old problems or create new opportunities. Early adopters make substantial returns. And this success attracts more and more capital from people who want to participate in the opportunity. But because the innovation is new, we don't have historical data on how it behaves in different conditions. We don't know what the failure modes are. We don't understand the second order and third order effects. And most dangerously, we tend to assume that because something is new and sophisticated, it must be safe. After all, it was designed by smart people using advanced mathematics and cutting-edge technology. What could go wrong? Let me give you a perfect example from 1987 that illustrates this pattern. In the early 1980s, a new financial product called portfolio insurance became very popular with institutional investors. The concept was elegantly simple. You could use computer programs to automatically adjust your portfolio as markets moved, selling stocks or buying put options as the market fell.
This would limit your downside risk while allowing you to participate in upside gains. The theory behind portfolio insurance was based on sophisticated option pricing models developed by Nobel Prize-winning economists.
The mathematics were sound. In theory, you could replicate the payoff of a protective put option by dynamically trading the underlying stock. This meant you could protect your portfolio without paying the high premiums that options dealers were charging. By 1987, portfolio insurance was managing over $90 billion in assets. That's equivalent to hundreds of billions in today's dollars. Institutional investors loved it because it seemed to offer the best of both worlds. You could stay fully invested in stocks and capture the upside when markets rose, but you were protected on the downside when markets fell. It seemed like a free lunch, which should have been the first warning sign. The problem, which became apparent only after the crash, was that portfolio insurance worked great when small numbers of investors were using it. But when everyone had the same strategy, and when markets started falling rapidly, all the portfolio insurance programs triggered at the same time. They all tried to sell stocks simultaneously, and there weren't enough buyers. On October 19th, 1987, Black Monday, the stock market fell 22.6% in a single day. It remains the largest one-day percentage decline in stock market history. And portfolio insurance, the product that was supposed to protect investors from crashes, actually made the crash much worse. The automatic selling triggered by these programs overwhelmed the market and turned what might have been a moderate decline into a historic crash. I was running Bridgewater at the time, and I watched this unfold in real time. It taught me a crucial lesson about innovation risk. Just because something is new, sophisticated, and designed by intelligent people doesn't mean it's safe. In fact, the newest and most sophisticated products are often the most dangerous precisely because we don't fully understand them yet. We haven't seen how they behave under stress. We haven't discovered their failure modes. We saw the exact same pattern in 2008 with mortgage-backed securities and collateralized debt obligations. These were incredibly complex financial products that even the people creating them didn't fully understand. The models said they were safe. The rating agencies gave them AAA ratings. Sophisticated investors bought them in enormous quantities. The models were based on historical data showing that mortgage defaults in different geographic regions weren't correlated. If housing prices fell in California, the thinking went, that didn't mean they would also fall in Florida or Texas. Therefore, if you pooled mortgages from across the country, you had a diversified portfolio where the defaults would largely cancel out. This assumption turned out to be catastrophically wrong. When housing prices started falling, they fell almost everywhere simultaneously. The correlations that were assumed to be low turned out to be very high during a crisis. And once defaults started rising, the entire edifice of mortgage-backed securities collapsed. The rating agencies, which had given these securities their highest ratings, were using models that had never been tested in a nationwide housing downturn. Why? Because there had never been a nationwide housing downturn in the modern era. Their models were based on historical data that didn't include the scenario that actually occurred. This is the essence of innovation risk. New products and new markets don't have enough historical data to reveal their true risks. By the time we discover the failure modes,
It's too late. The system is already saturated with these products, and the unwind causes enormous damage. Today, I see similar innovation risk in several areas, and it concerns me greatly.
cryptocurrency is the obvious example. We're seeing trillions of dollars of value in digital assets that have no intrinsic value, no cash flows, and no regulatory oversight. The technology is new and complex, which makes it seem sophisticated and therefore safe. But we have no idea how these assets will behave in a real liquidity crisis. What happens when cryptocurrency exchanges face bank runs? What happens when Tether or other stablecoins come under stress? What happens when governments decide to crack down on cryptocurrency use for money laundering or tax evasion? We don't know because we haven't been through a full cycle yet. I also see innovation risk in algorithmic trading and high-frequency trading. More and more trading is being done by computer programs that can react in microseconds. These programs are designed to identify patterns and exploit them faster than human traders can. But what happens when multiple algorithms start interacting in unexpected ways? What happens when they amplify each other's actions and create feedback loops that their programmers didn't anticipate? We got a preview of this in the flash crash of May 6, 2010, when the stock market briefly fell almost 10% in minutes before recovering. But that was just a preview. The algorithms are faster now, more prevalent, and more sophisticated. The next flash crash could be much worse, and it could happen when markets are already stressed by other factors. The fourth and final pattern is what I call the policy trap. This is when policymakers, the Federal Reserve, the Treasury Department, Congress, central banks around the world get caught between a rock and a hard place. They can see problems building in the system, but any action they take to address those problems risks triggering an immediate crisis. Let me explain the dynamics of the policy trap, because understanding this is crucial to anticipating when crashes will occur. In the years leading up to a crash, policy is usually loose. Interest rates are low, regulations are relaxed, governments are running deficits. This loose policy is what fuels the boom. It makes borrowing cheap, which encourages risk-taking and inflates asset prices. At some point, policymakers start to recognize that imbalances are building. They see debt levels rising to dangerous levels. They see asset bubbles forming. They see excessive risk-taking in the financial system. And they know intellectually that they should tighten policy. They should raise interest rates to cool down the economy. They should increase regulations to reduce risk in the financial system. They should reduce government deficits to prevent debt from spiraling out of control. But here's the trap. By the time they recognize the problem, the economy and financial system have become so addicted to loose policy that any significant tightening threatens to trigger a crash. If they raise interest rates aggressively, heavily indebted companies and consumers won't be able to service their loans and will default. If they dramatically increase regulations, it could choke off credit and kill the expansion. If they cut government spending sharply, it could push the economy into recession. So they're stuck. They can keep policy loose and let the imbalances grow even larger, knowing that this makes the eventual crash even worse. Or they can tighten policy now and risk triggering the crash immediately. It's a lose-lose situation. And it's what makes market timing so difficult, even when you can see the problems building. We saw this play out clearly before 2008. By 2004 and 2005, Federal Reserve officials were expressing concern about housing prices and lending standards. They could see that housing prices were rising much faster than incomes. They could see that mortgage lending standards had deteriorated badly, with large numbers of no documentation loans, negative amortization loans, and subprime loans being originated. The Fed started raising interest rates in June of 2004. Over the next 2 years, they raised the federal funds rate from 1% to 5.25%. This was an attempt to cool down the housing market and reduce the risk-taking in the financial system. But they didn't raise rates fast enough or high enough to really stop the bubble from inflating further. Why? Because they were worried about triggering a recession. The economy had only recently recovered from the 2001 recession and the dot-com crash. The Fed didn't want to be responsible for causing another downturn. So the housing bubble kept growing through 2005 and 2006. More debt was accumulated, more risky loans were originated, more complex securities were created. And when the bubble finally burst in 2007, the crash was much worse than it would have been if they had acted more aggressively earlier. But here's the thing. Acting more aggressively earlier would have required the Fed to deliberately cause a recession in 2004-2005. No policymaker wants to do that. Their incentives are to keep the expansion going as long as possible. They get blamed for recessions that happen on their watch, even if those recessions are necessary to prevent larger problems down the road. Today, we're in an even more severe version of the policy trap. After the 2008 crisis, the Federal Reserve cut interest rates to zero and kept them there for 7 years. They also implemented quantitative easing, purchasing trillions of dollars of bonds to push down long-term interest rates and support asset prices. This emergency policy was necessary to prevent a complete economic collapse in 2008 and 2009, but it also created massive distortions in the economy. Companies took on enormous amounts of debt at ultra-low interest rates. Zombie companies, firms that don't generate enough cash flow to service their debt but survive by continuously refinancing, proliferated. Asset prices, stocks, bonds, real estate, everything, inflated to record highs relative to fundamentals. And the entire system became dependent on the continuation of near-zero interest rates and central bank support. When inflation finally forced the Fed to start raising rates aggressively in 2022, we immediately saw stress points in the system. Several regional banks failed in early 2023. The commercial real estate market started showing significant cracks. Highly leveraged companies started struggling with higher debt service costs. And the Fed had to slow down their rate hikes because they were worried about causing broader financial instability. This is the policy trap in its purest form. The Fed knows that inflation is still above their 2% target. They know that keeping rates at current levels, or heaven forbid, cutting them prematurely, risks reigniting inflation or creating new asset bubbles. But they also know that keeping rates high for an extended period or raising them further risks triggering failures in parts of the financial system that became dependent on cheap money. There's no good solution. Either way, pain is coming. The only question is whether it comes as a crash now or as an even bigger crash later after the imbalances grow larger. Now, let me tie all four patterns together and show you how they interact to create crashes. Because it's not just that these patterns appear separately. They feed off each other and create a self-reinforcing cycle that makes crashes inevitable once the patterns are all in place. It starts with loose policy and low interest rates. This encourages borrowing and risk-taking. Asset prices start rising. As prices rise, bubble psychology sets in. People start buying not because of fundamental value, but because they expect prices to keep rising. More buyers enter the market, including retail investors and speculators who are attracted by the profits others are making. As the bubble grows, debt saturation develops. People borrow more and more money to buy inflated assets. Leverage increases throughout the system. Debt-to-income ratios rise. The system becomes increasingly fragile, though this fragility is hidden by rising asset prices that make the debt burden seem manageable. Then innovation amplifies everything. New financial products make it easier to take on leverage and make bigger bets. Complex derivatives and structured products hide the true level of risk in the system. Everyone thinks they're hedged and protected, but they're not. The correlations and failure modes only reveal themselves during the crisis. Finally, the policy trap emerges. Policymakers see the problems building but feel powerless to stop them without triggering an immediate crisis. They try to engineer a soft landing, gradually tightening policy to let the air out of the bubble slowly. But bubbles never deflate gradually, they always pop suddenly and violently. When the crash finally comes, all four patterns work in reverse to create a devastating downturn. The bubble psychology shifts instantly from greed to fear. Everyone who was buying now wants to sell, and they all try to sell at the same time. Prices fall sharply. The debt saturation becomes a debt crisis. All those people who borrowed money to buy assets now can't make their payments as asset prices fall and incomes decline. Defaults rise, banks pull back on lending, credit conditions tighten. This creates a vicious cycle where falling prices lead to more defaults, which lead to tighter credit, which leads to lower prices. The innovation that seems so brilliant on the way up becomes the mechanism that accelerates the crash on the way down. Portfolio insurance selling in '87, CDO liquidations in 2008, algorithmic trading amplifying moves in future crashes. The sophisticated products that were supposed to reduce risk end up magnifying it during the crisis. And policy, which was trapped before the crash, is now overwhelmed after it. The Federal Reserve cuts rates to zero, but it's not enough. Governments pass massive stimulus bills, but it's not enough. Because when you have to unwind years or decades of excess in a short period of time, there are no easy solutions. The debt overhang is too large. The misallocation of capital is too severe. The psychological damage is too deep. This is what I call a big debt cycle deleveraging. It's the most painful economic event a society can experience, short of war. Unemployment spikes. Asset prices collapse. Businesses fail. The social and political consequences can last for a generation. We saw this after the Great Depression. We saw a milder version after 2008, and we'll see it again when the current cycle reaches its conclusion. Now, let me assess where we are today in this cycle across each of the four patterns. This is crucial because understanding the current state of these patterns allows you to position yourself appropriately before the crash occurs. On bubble psychology, I see very concerning signs in multiple areas. Cryptocurrency went through an enormous bubble in 2021, crashed in 2022, and is now inflating again. Bitcoin has reached new all-time highs despite having no fundamental changes in its utility or adoption. Parts of the stock market, particularly anything related to artificial intelligence, are trading at valuations that are extremely difficult to justify based on any reasonable projection of future cash flows. I hear that phrase, "this time is different," constantly, usually in reference to AI. People tell me that AI is fundamentally different from previous technologies, that it will create unprecedented productivity growth, that traditional valuation metrics don't apply to AI companies. This is exactly the same rhetoric I heard about internet stocks in 1999, about housing in 2006, about cryptocurrencies in 2021. The valuations in the AI sector are particularly extreme. Companies with minimal revenue and no path to profitability are trading at multi-billion-dollar valuations based purely on the belief that AI will somehow make them valuable in the future. This is speculation, not investment, and it's classic bubble psychology. On debt saturation, the numbers are deeply concerning and in some ways worse than before 2008. As I mentioned earlier, global debt is now over 300% of global GDP. U.S. government debt is $35 trillion, roughly 130% of GDP. This is peacetime debt at levels we usually only see during major wars. Corporate debt is also at record highs. Many companies borrowed enormous amounts when rates were near zero, and they're now facing refinancing at much higher rates. Commercial real estate is particularly vulnerable. Office buildings financed at 3% rates are now worth much less because the capitalization rates have risen to 6 or 7% or higher. Many of these properties are worth less than the debt on them, which means defaults and foreclosures are inevitable. Household debt is more manageable than before 2008 in some ways. Most mortgages are fixed rate, so rising interest rates don't immediately impact monthly payments for existing homeowners. But other forms of household debt, credit cards, auto loans, student loans, are at very high levels. And younger households that bought homes recently at high prices with higher mortgage rates are stretched very thin. What really concerns me is the composition of the debt. Much of the corporate debt is in the form of leveraged loans and high-yield bonds issued by companies with weak credit. During the zero interest rate period, investors desperate for yield bought these risky bonds, and companies with questionable business models were able to borrow at relatively low rates. When the economy slows or enters recession, many of these companies will default. On innovation risk, we have several very concerning areas.
Cryptocurrency and decentralized finance represent new asset classes and financial structures that have never been tested in a true liquidity crisis.
We don't know what happens when a major stablecoin breaks, or when a large cryptocurrency exchange fails, or when governments crack down hard on the industry. These are all plausible scenarios, and any of them could trigger broader financial instability. Artificial intelligence itself represents a form of innovation risk. Not because AI isn't real or useful, but because we don't fully understand how AI systems will behave as they become more powerful and more widely deployed. What are the failure modes of large language models? How will AI-powered trading systems interact during market stress? What happens when critical infrastructure depends on AI systems that can fail in unpredictable ways? We're also seeing innovation in financial market structure that concerns me. Enormous amounts of trading now happens through zero-commission retail platforms that use payment for order flow models. Options trading by retail investors has exploded. Special purpose acquisition companies proliferated in 2020 and 2021. Non-fungible tokens had a brief mania. Each of these represents a new way for retail investors to speculate, and each has the potential to amplify volatility during a crisis. On the policy trap, we are absolutely and completely stuck. The Federal Reserve raised rates aggressively in 2022 and 2023 to fight inflation. They took the federal funds rate from 0 to over 5% in roughly 18 months. This was necessary because inflation had reached levels not seen since the 1980s. But now they're trapped.
Inflation has come down from its peak, but remains above the Fed's 2% target. This suggests they should keep rates high or even raise them further.
But they can't do that because of the financial stability risks I mentioned earlier. Regional banks are under stress. Commercial real estate is struggling. Highly leveraged companies are suffering. The government itself is paying over $1 trillion per year in interest on the national debt. So the Fed is stuck between needing to keep rates high to finish the job on inflation and wanting to cut rates to alleviate financial stress. Either choice has negative consequences. If they keep rates high, something in the financial system will eventually break. If they cut rates prematurely, inflation could reaccelerate or new asset bubbles could form. This is the classic policy trap, and there's no good way out of it. The best they can hope for is to navigate between these constraints and engineer a relatively mild recession that reduces inflation without causing a financial crisis. But that's a very narrow path, and the historical record suggests it's unlikely they'll be able to walk it successfully. So, putting it all together, what does this mean for investors? I see all four patterns present in today's environment: bubble psychology in parts of the market, debt saturation at levels equal to or exceeding 2008, innovation risk in multiple areas, and a severe policy trap with no good solutions. Does this mean a crash is imminent? Not necessarily. As I've emphasized throughout this analysis, timing crashes is extremely difficult, if not impossible. These patterns can persist for years before they resolve in a crisis. The dot-com bubble inflated through 1998, 1999, and into early 2000 before finally popping. The housing bubble grew from 2003 through 2006 before crashing in 2007 and 2008. But what I can tell you with high confidence is this: the longer these patterns persist, the worse the eventual crash will be. The more debt that accumulates, the more painful the deleveraging. The higher asset prices rise above fundamental values, the further they have to fall to reach equilibrium. The more complex and opaque the financial innovations, the more difficult it will be to understand and contain the crisis when it comes. So how should you position yourself? At Bridgewater, we use what I call an all-weather portfolio approach. The idea is to construct a portfolio that can perform reasonably well across different economic environments: growth or recession, inflation or deflation, rising rates or falling rates. You don't know which scenario will unfold, so you position yourself to survive and even profit under multiple scenarios. This means holding a diversified mix of asset classes that respond differently to different conditions: stocks for growth environments, bonds for deflationary environments, inflation-protected securities, and gold for inflationary environments. Some cash for optionality and to take advantage of opportunities when they arise. The specific allocations depend on your individual circumstances, your time horizon, your risk tolerance, and your financial goals. But the principle is universal. Don't bet everything on one scenario. Don't try to time the market perfectly. Don't concentrate all your wealth in a single asset class or geography. Within this framework, here are some specific principles I follow. First, be extremely cautious about leverage. Leverage is what turns market downturns into catastrophic losses. If you own assets without leverage, you can wait out a downturn and eventually recover. If you're leveraged, you can be forced to sell. at the worst possible time, locking in permanent losses. In an environment where all four crash patterns are present, minimizing leverage is crucial. Second, focus on quality. In good times, low-quality assets can do well just riding the momentum. But in crashes and their aftermath, quality matters enormously. Companies with strong balance sheets, real competitive advantages, and genuine cash flows will survive and eventually thrive. Garbage companies will disappear. Real estate in good locations with real demand will hold value better than speculative properties in marginal areas. Third, maintain liquidity. When crashes occur, cash becomes extremely valuable. Asset prices fall. Opportunities appear. But you can only take advantage if you have the liquidity to act. Don't be so fully invested that you have no ability to respond when opportunities arise. Keep some dry powder. Fourth, think globally. The United States is not the only market. Different countries are at different stages of their debt cycles. Different regions face different risks and opportunities. A globally diversified portfolio reduces your exposure to any single country's problems. Fifth, and perhaps most importantly, control your emotions. The biggest mistakes investors make during crashes are emotional mistakes. Panic, selling at the bottom, refusing to recognize losses and holding on to garbage, becoming paralyzed and unable to act, chasing whatever asset class performed well most recently. If you understand these four patterns, if you can see them building in real time, you can position yourself appropriately before the crash occurs. And when the crash does come, when everyone else is panicking, you can remain calm because you understood it was coming and prepared for it. I've been studying markets and economic cycles for over 50 years. I've managed money through multiple crashes and crises. And the single most important lesson I can share is this: the patterns always repeat. The details change. The specific assets involved change. The particular innovations and policy responses change. But human nature doesn't change. Greed and fear, boom and bust, bubble and crash. These cycles are as old as markets themselves and will continue as long as markets exist. So watch for the four patterns.
Bubble psychology, where people buy based on momentum rather than value. Debt saturation, where borrowing grows faster than income. Innovation risk, where new products create hidden vulnerabilities.
And the policy trap, where authorities are stuck between bad options. When you see all four patterns present and building on each other, that's when you know a major crash is likely coming. You can't predict exactly when it will happen, but you can prepare for it. You can reduce leverage, focus on quality, maintain liquidity, diversify globally. And most importantly, you can maintain the emotional discipline to stick to your plan when everyone around you is panicking. That's what I've learned from 50 years of studying crashes. That's how I think about positioning for the current environment. And that's what I believe will help you navigate whatever comes next in the markets. The crashes are inevitable, but being a victim of them is optional if you understand the patterns and prepare accordingly.